Good morning. The BRICS countries are Brazil, Russia, India, China, and South Africa. And this organization now has another dozen countries that are either in or on the way. And a major draw for countries who join with the BRICS is their development of a new global trading system, which is completely independent of the US-led system based on US dollar trading and the SWIFT bank system. The system that we use in Western countries, that one which is trade denominated by US dollars and executed by Western banks, that has obvious advantages to us and obvious disadvantages to everyone else. If we're honest with ourselves, there is no logical reason why a farmer in Brazil who's selling soybeans to China should use an American bank or the exchange in Chicago to make the deal happen, or need US dollars to do so. US banks would be paid to convert Chinese renminbi to US dollars, then charge Brazil for exchanging USD to real. It's slow, it's expensive, and that is the system up to now. And that system is going away. There is another feature of this arrangement that's also very advantageous to operators inside the system, which is price discovery. Decision makers across the world can see markets. We can see that China just bought 1 million tons of soybeans from Brazil because our people executed the trade. We can see the contracts because we created the contracts and put them on our own exchanges. We can see the prices, which are being updated in real time on our screens. Now, China, Brazil, and the other BRICS have the technology to build their own system, buying and selling directly, without US dollars, without Western banks, and without going through commodities traders and going through exchanges in Chicago. So as all this business and this global trade moves toward the new BRICS trading systems and out of ours, we don't see the prices anymore. We don't see the real global demand. We don't know where the supply is coming from to satisfy the demand. We are flying blind because the information feedback loops that we build into our systems, those are gone. And this transformation of global trade to a non-US dollar denominated system outside SWIFT and with immediate settlement, this is going to hurt all of our producers in the extractive and agricultural industries first. Oil companies, miners, and farmers. Every planting season, each spring, farmers across the world play the oldest and biggest poker game. They determine what they should plant that is going to bring in the most revenues come harvest time. To do that, they need to make a series of well-educated guesses with respect to their own costs, what other farmers around the world may be doing, and they need to have a good feel for what global demand is going to be. Farmers in North America and Europe spend a lot of money for professional advice and for the best information as to what is happening right now. And then they watch the futures markets very carefully for any news that's going to impact the prices of what they have growing in their fields. And we know what's been happening to their input costs. They're going up by a lot. Across the board, everything costs more on the farm. So it becomes crucially important to get the rest of the forecast right because they're already operating on thin margins. This is a strong analysis, and we'll begin with their conclusion. 2019 was the first time that the United States had a trade deficit in agriculture. Since then, we've run big trade deficits in agriculture for 4 out of 6 years, and this year we will hit a record. What has always been true? That the United States is the breadbasket to Europe and to big chunks of the Northern Hemisphere. American farmers can feed the world, they say. Now we can't feed ourselves. We're importing more than we're exporting. That's what a trade deficit is. Here's the chart. The blue line is U.S. agricultural exports running above the orange import line forever. They crossed 5 years ago, and now they're diverging fast. The analysis from the American Farm Bureau Federation, they are worried. Commodity prices are falling for U.S. corn and soybeans, down 30% in 12 in just 1 year, but exports have not risen. You would expect that falling prices would stimulate global demand, but not this time. China is buying more from Brazil, and so U.S. farmers are sending their surpluses to Mexico, which is the top export destination for the first time ever. Earlier this year, China set off alarm bells when they canceled huge wheat orders from the US and from Australia. We did a piece on it here and said that this was just the start of things to come. China canceled 240,000 tons of US soft red, then came back the following Friday, canceled 264,000 tons. China called up Australia and canceled 1 million tons from there. The cancellation was the biggest ever, and Bloomberg tells us the obvious, that China found cheaper wheat from somewhere else. Ben Buckner is the chief grains analyst for a company in Chicago. Chicago is where our biggest agricultural exchanges are. We spend a lot of money for Bloomberg to tell us what's going on, but they don't know either, where China bought 1.5 million tons of wheat to replace their canceled buys from the US and from Australia. They don't know, and so neither do the farmers who rely on Chicago grains analysts or on Bloomberg to tell them what's going on. I mean here that the farmers in the United States and Australia planted 1.5 million tons of wheat, and then China canceled them. But nobody knows who filled that demand. Was it more productive farms in China? Was it Russia? Was it Brazil, outside of our trading systems? Our people don't know. And it wasn't just wheat. Corn inventories were up 13%, soybeans by 9%, behind wheat, which was at 16%. These increases, millions and millions of tons of farm product, and the buyers are gone, and nobody knows why. Here are the prices paid for Chinese corn and wheat, hitting multi-year lows. So they are getting their demand filled from somewhere. We just don't know where. We look back now and have learned that the demand was met by a combination of all three, actually. China had a near record harvest. Russia and Brazil stepped up their exports, but it was outside our system. We only learned about it later. And it was obviously at lower prices than they were getting from the US and Australia, or they wouldn't have canceled the trades, and we wouldn't see the prices heading lower. Bloomberg is scrambling and trying to figure out things. Here in this one, they notice that China's imports of both wheat and corn are in a steady decline. When this article was published, the USDA was still forecasting big Chinese imports from the US, but if those imports go down, a big demand driver just disappears. This is one of the biggest stories in the world, and nobody is talking about it and what it means for our companies in a nuts and bolts way, trying to do business in the real world when we don't know what the prices are anymore. The BRICS countries are doing giant volumes of business now, outside of our systems and outside the dollar. This is $1 billion problem for a Chicago bank that makes risk-free profits every year just processing trades. But for tens of thousands of farmers outside Chicago, it's $1 million problem. They planted wheat that there are no buyers for, and they don't know why. But this is why. For 100 years, we've had a system that the world had to use because the technology wasn't there to do it any other way. Now the technology is here. Distributed ledgers, central bank digital currencies, immediate cross-border settlements at zero cost. It's here. The BRICS countries are building a new system and they're almost finished. And that means that our system is almost finished too. This is Dalian, Liaoning. Be good.